We are in Chapter 3, Objective 3, Adjusting the Accounts. And this is a really super important part of your learning, because after you get this general idea of adjusting accounts, most of the rest of the course is going to just be learning new adjustments. So if you're not comfortable with the general process of an adjustment, you're going to have trouble moving forward. So definitely make sure you invest a good deal of time in getting comfortable with adjustments and adjusting journal entries. So what is an adjustment? In words, it's a little bit difficult to be 100% clear about. So we're going to talk about it, and then I think when you do these adjustments, you'll start to see. So an adjustment is a journal entry, and we're going to recognize an expense or revenue, and just by virtue of debiting expense or crediting revenue, we're going to have an offsetting debit or credit to a balance sheet account. The journal entry is not associated with payments or receipts of cash, so it's not part of cash accounting, or other transfers. So sometimes people don't necessarily pay with cash or promise to pay cash. They may transfer property to you that's not cash, or they may let you off the hook for a debt. So those would be what we call normal journal entries. But these adjustments have a revenue or expense, and then some other account that doesn't involve a transaction with an outside party. This adjustment will reflect the impact of a transaction and complies with GAAP. So we're going to be looking at our accounting rules, and it will tell us the accounts that are impacted and the amounts. So adjusting journal entries, these are the key part of the adjustment process. It's a specific type of journal entry, records an expense or a revenue, and adjusts at least one other account, an asset or liability, but does not include a transfer from an outside party or an outside corporation. So we're talking about accrual accounting in Chapter 3. Accrual accounting happens via adjusting journal entries. Adjusting journal entries are accrual accounting. So this is what adjusting journal entries is what corporate accountants do to prepare the financial reports. Now, how do you know which accounts to adjust and how to adjust them? You're going to have to get some experience and just do them. So you're going to learn a transaction, do some analysis under GAAP, record the journal entry, and then post it. So the process you learned in Chapter 2 still applies. There still is a journal entry. It does get posted, and you update a balance. That all still holds. This is just a special set of journal entries that capture the impact of events during the reporting period that were not cash. Okay, so we're still in Objective 3.3 here. There's a lot on this slide. Let me see if we can squish it in. There we go. There are 3 types of adjusting journal entries: deferrals, accruals, and depreciation. It's unfortunate that the second type is an accrual, because we're talking about accrual accounting. All 3 of these are examples of accrual accounting. So an accrual is a special part of accrual accounting, but deferrals, accruals, and depreciation are all accrual accounting. All right, so deferrals, we get the cash now, but we don't record the revenue or expense till later. Okay, so what are we deferring? Defer means defer the revenue or expense. To accrue something is to recognize it now. So we recognize the expense or revenue now, but the cash comes later. And depreciation, this is for long-term assets, and it's going to be a systematic allocation of the cost of that asset to a reporting period. And here, this third one is it's going to be a little easier, because depreciation expense is going to be the only type of expense under depreciation. let's look at some examples for deferrals. You pay your car insurance, or a corporation does. They pay it for a year. They're going to expense it over the next 12 months. They pay for a subscription to Dropbox.com today. They expense it over the next 12 months. So it doesn't get expensed on the day it's paid. It gets adjusted at the financial reporting period date, and all or part of it may be expensed at that time. Dropbox.com, the company, receives a payment today for 1 year service. They'll record the revenue over the next 12 months. So they got paid now, but it's for service provided in the future. And maybe some of you have experience with car insurance. If you cancel your car insurance, you'll get your money back because you didn't use up part of it. So they had not accrued their insurance revenue, and they return the cash to you. So some examples of accruals. Interest has been earned by the bank, but the payment is until the end of the quarter. So every day the bank accrues interest on any outstanding loans, but it doesn't get paid till some set date, monthly or quarterly or annually. Okay, so you may expense it today. The bank may recognize interest revenue today, but they'll receive the payment later and you'll pay it later. A sale on account is another example of an accrual. We record revenue now, receive payment later. Another example is salary expense. So we have salary expense, sales revenue, interest expenses are examples. Employees work up to the reporting date, like December 31, but payday is next week after the end of the reporting period. You're going to record the salary expense now for what you owe them, and you'll pay the salary later. Okay, and the final one here for the depreciation. You have a $50,000 delivery truck. You think it's going to last 5 years, not be worth anything at the end. You'll say, 5 years, we'll take $10,000 as depreciation expense each year. You have a $100,000 backhoe. You think it will last 10 years, be worth nothing at the end. We'll take 1/10 of that a year, or $10,000 as depreciation expense. Okay. So those are the three types of adjusting journal entries: deferrals, accruals, and depreciation. And we're going to get into actually writing some entries in the next video.